Hello traders, it's Friday, January the 24th. This is John Kicklighter, Chief Strategist for DailyFX.com, here with your FX market wrap-up for the past 24 hours of trading and an outlook for what we can expect in the final 24 hours of this trading week. Traditionally, I say Fridays are typically the slow day of the week. Not many people want to take major positions into the weekend, especially if it's an opening position. But I have to say things are a little bit different this time around because we did have some pretty severe volatility and price adjustments over this past 24 hours. Now, of course, when I'm looking at volatility, I always start from a top-down approach. I like to look first at risk. Lo and behold, the S&P 500 made quite the break to the downside. All right, technical wedge here. We were talking about this in the strategy video the other day, that this was one of those inevitable breakouts. Indeed, we would get a breakout. I remember what the lesson was from that breakout. It must find follow-through, otherwise it's just a move through a technical boundary, and it doesn't necessarily give us something to trade with. This was, nevertheless, a very remarkable move, and it has a lot of people sitting on the fence, wondering whether there is going to be a substantial follow-through, whether we are indeed within a risk-averse scenario, or whether this was a sudden drop that will subsequently be retraced. Right? The answer to that question will have very substantial impact on how the markets can trade in the next 24 hours and how they will also trade into the first half of next week. Now, I do want to warn you, though, that when you're placing your trades and you're making your call on market conditions, one of the primary primary trade conditions that we have to put together, remember what your time frame is. Okay, because while the opening 24 hours of next week is light, it is anything but light through the rest of the week. All right, we're talking about GDP for the UK. We're talking about investment conditions in Portugal. Very big considerations right now. Wednesday, FOMC rate decision. Huge piece of event risk. Spain's final bank assessment. All right. We have U.S. GDP on Thursday. We have unemployment change for Germany. We have Spain's fourth quarter GDP. We have Japanese CPI. We have Friday the Eurozone unemployment and CPI estimates, the two indicators that instigated the ECB's November rate cut. All right, there are huge event risks next week. Knowing that, market participants often will hold off on major investments because they want to see how this investment forecasts will change with the release of that data. All right, so we have some very interesting considerations on our hands. All right, my first and foremost concern is how genuine is this risk move here. All right, well, let's look at the data. We don't necessarily have to have a fundamental push for a risk-based move. You can ask any of the analysts, especially Jamie, who is very much a believer in the shift in sentiment as it occurs in price and not necessarily as it occurs on the economic docket. But it often helps to have a catalyst, especially when you're looking for follow-through. So when we have a catalyst that can engender all the market's focus, put it on one fixed point, you're much more likely to have the market lurch forward or down, if you will, and continue in that direction because everyone's thinking about the same thing. Everyone is concerned about the same thing. Well, looking at the docket that we had, I don't think this past 24 hours really generated much of anything huge. All right, there was a iffy view of global manufacturing activity, although there was a notable performance from the Eurozone, which is what many people associated the Euro's exceptionally strong performances. But the risk consideration does not look like it was triggered by that event risk. All right, look at this Euro USD. Now, we know this is the most liquid currency pair in the market. This, like any other currency pair, will at some point, some level of severity and risk-based trends respond to its safe haven and risk appetite appeal. All right, the U.S. dollar at a very extreme level will be valued for its liquidity and thereby act as a safe haven. When the markets are looking and seeking out yield, which they have been over the past months, which has driven the yields in the euro area. All right, so we've been looking at the Spanish and Italian bond yields for some time, and even Greek yields here. As the market looks to pour money into the government bonds of these periphery Eurozone economies, we see that their value rises and their subsequent yield falls. The cost at which these governments have to pay to borrow falls. They're at extreme lows. All right, so this is your more risk-sensitive currency in the Euro-USD pair. So under the consideration that we had a risk aversion move this past session, why did the Euro-USD jump? Was this the same consideration elsewhere? Well, if we look at the pound-dollar, the pound, the higher yielding currency, or the one that looks like it's going to have a higher yield going forward, outperformed. All right. There was a little bit more straightforward performance, although it was very moderate, with the Aussie USD, which I am actually short. And you can see that that bounce to hold this former support as new resistance has indeed played through to the next stage. Now, we were talking about the Aussie USD, and the Aussie USD may not be the best measure for this circumstance because in these fundamental scenarios, the Aussie dollar would be bearish on risk aversion, neutral, although probably bearish as well when we're talking about risk appetite because the Aussie USD has not shown a good correlation to traditional assets like the S&P 500, and even monetary policy. So this might not be the best measure for a true risk trend. But where most traders were finding the assessment of risk aversion to complement the U.S. and European and Asia equity markets was this huge drop in the yen crosses. All right, dollar yen here, the U.S. dollar is a safe haven currency, as is the Japanese yen. They're not actually just basic pure safe havens. The dollar is better for liquidity, and Japan is better when you're talking about unwinding carry trade that has been building up for months on end on the devaluation of the Japanese yen. So unwinding this buildup in carry trade pairs that do not provide meaningful carry trade, which you can see here in the Aussie yen. All right. So we call them safe havens. They're safe havens under particular circumstances. But when we see a very substantial swell in risk aversion or risk appetite, which doesn't matter which one, but when you see that there is a very severe move in sentiment, that's when it doesn't really matter what the impetus for the appetite for safety or appetite for yield is, they just go to it. All right? But when we break this down, the severity becomes very important because we want to see exactly what's moving. And this is the consideration that I gave for the dollar, because I've had a lot of people ask me in recent past, not just over the past couple of weeks, but past months, whether the U.S. dollar is not a safe haven currency anymore. And with the dollar dropping back to the bottom of this channel, you can see this channel right here, at the same time that U.S. equities are dropping, that is a very valid concern to have. I talked specifically about the dollar in today's strategy video. It definitely is still a safe haven. But the answer to that is that the dollar is dropping because while we are having a risk aversion move, it is not the kind of severity that we get that actually bolsters its value as a safe haven. That's liquidity. All right. So where was the safe haven demand coming from? Well, there's a reason that the yen crosses were more sensitive to that kind of this kind of risk move, while the euro dollar and pound dollar, pairs that would traditionally respond to these kind of circumstances, did not correct. All right, and that's because the source was not from the structurally important areas of the financial system. Now, when we look at this, we actually see the S&P 500 versus the emerging markets. You can see that both of them dropped, but the emerging market measure is actually already at its lowest level in over 4 months. All right, you do have a very meaningful correction and trend lower. We've seen a lot of actual deviation from benchmarks like the S&P 500, which are backed and reaffirmed by monetary policy and actual positioning in exceptionally extended assets like emerging markets. But this past session was made all the more dramatic, specifically because of the emerging market currencies. We did have some very substantial moves in particular members, but it was the Argentine peso that was the big mover. As you can see here in the bright red, I try to make it as obnoxious a color as possible to really give you a sense of how it has developed. This is just since June. All right, let me back us out a little bit here. All right, there's the dollar yen and there's the peso. You can see how incredible the increase has been just over this past day. Nearly 12%. Huge. Huge. And while we might say, why does the Argentine currency have such a meaningful influence in the markets, you just have to think back to the long-term capital instance, right? Or back during the Asia financial crisis back in 97, 98. That was actually began in the smaller Asia countries, but it quickly had global implications, and the risk impact was quite severe. Right? It created substantial problems for Japan and hedge funds thereafter. All right? So it can start anywhere, sentiment. But whether we see it really hit and start something more substantial, knocking dominoes down through the financial system, remains to be seen. This was absolutely a very remarkable day in terms of volatility, but it does not necessarily get to the point where we're seeing full-blown, consistent risk aversion. All right? That is the concern that I have. If we were to see risk aversion, if risk aversion to an aggressive level were to continue, I would expect this trend to establish a continuation to the downside, so the S&P 500 dropping. Now, we know there are plenty of opportunities to take advantage under those circumstances. A lot of people like the dollar yen, for example, for the yen crosses, and you can see a break of a couple technical levels there. Not my favorite setup. All right. If I were to see a pure and consistent and heavy risk aversion theme, I'm going to go for something like a euro yen. All right, because the euro has been over leveraged. Expectations are too excessive. The capital inflow to the eurozone too strong. And subsequently, when we're talking about risk aversion or volatility, remember that's capital inflow. Investors looking for higher yield, not concerned about the fact that a country like Spain has a 26% unemployment rate. They're just looking for those yields. And right now, those yields aren't even that attractive. Right, because they have significantly devalued because of the appreciation of the bond itself. So, you start to see this shaking loose, you see the euro start to pull apart, and that leaves the euro yen very, very elevated, and you can see that reversal kick in. As for the carry currencies, the more carry illustrious yield pairs, the Aussie yen has already made a break, a substantial break here to the technical floor. The CAD yen, which I pointed out was looking a lot like the Aussie yen, well, it looks so much like the Aussie yen that it broke its floor as well. All right, these could find follow through absolutely, but they must have risk aversion, all right, because these are carry heavy currencies. You'll be paying if you try to short these, and paying quite handsomely. Though it's not as big as it has been historically, it's still expensive. The most expensive, but the most attractive technical position, because it has not already lost half of its recent build-up, is the Kiwi yen. All right. A head and shoulders pattern here, as you can see with the neckline, I would call it roughly 85.50 to 85.25. A break to the downside can open up a significant pullback. Now, once again, you need risk aversion. You need to have that consistent drive because you have to compensate for the carry that you're going to be paying if you're on the short side. All right. Not a problem if you're in the euro yen, because the carry is actually, the yield differential is virtually nil. In fact, at overnight swap rates, you're actually seeing a lower yield on the euro. But the euro yen and that concept is a similar situation to the euro dollar. If we see risk aversion, what happens to the euro dollar? Right? If risk aversion kicks in heavy enough, heavy enough that we really start to value liquidity, dollar is going to start to bounce, especially off of this floor. People treat it more like a safe haven. They've held back this time, but they're going to treat it more like a safe haven. Now against a euro, where the fundamentally risky currency, the euro will start to pull back. I've actually already taken a small short position here. I placed a stop approximately 37.50, 37.40, and this is a pretty straightforward situation. Now, if it does make a break to the downside, risk aversion kicks in, and I see evidence of that, then I'll put up to a full-size trade. But this is a risk aversion late bloomer, where the euro has been temporarily propped up and confusing a lot of traders. But you can see that pullback if risk aversion kicks in. But what if risk appetite moderates? The euro dollar is more likely to moderate as well, because we do not want to see a strong fundamental drive into the end of the week. Many people are going to shy away from taking major investments. This is especially true because next week, just like pretty much all the majors, there is going to be some very substantial event risk for the Eurozone. The Eurozone Finance Ministers meeting. All right. We have the Portuguese measure of investment, foreign investment. We have the Spanish bank review, as I said. You have the Spanish GDP, the German employment, Eurozone confidence figures. These are some very important pieces of event risk. And it's going to be very difficult for investors to take meaningful exposure ahead of that event risk. Right? So Euro USD is looking like a good setup. That's why I took a half-size position, half-size short, to add to my Aussie dollar short, as well as my other exposure, my Euro Kiwi long. All right. My Euro Kiwi long has actually soared. I actually updated overnight that I had hit my first target. My first target was 100 pips. Hit it overnight. I'm now up 200 pips on the second half. We'll see what happens. I am, for the moment, going to sit with it. Now, we also have an RBNZ rate decision next week, which is going to make this quite interesting. This is a pretty hefty carry. Just like I talked about the Kiwi yen, this pays carry. This is an expensive carry as well. But we want to see exactly what, to an extreme, the carry can, or the interest rate expectations can do. Because if RBNZ, who has been talking, the market has been talking up rate hikes for months now, if they do not move at this upcoming session, which actually the consensus amongst economists is they don't, there could be something of a letdown. And subsequently we have a possible rally here as the Kiwi drops off, having overextended its premium. Now, one contingency here that I want to remind you of, while we do want to watch the US dollar as a safe haven currency, and we watch for volatility to show what its bearings are. Here's the dollar versus the FX volatility index. Remember, there is another aspect to this currency that is very important, and that is monetary policy. All right. If you want to see the U.S. dollar continue this advance, and remember, this advance has occurred through very substantial appreciation in equities and other risk-based assets, higher yielding assets, you want to see the backdrop improve for interest rate forecasts. In other words, you want to see the Fed, at its upcoming rate decision, follow through with the taper. That is a very important aspect. Relative monetary policy, relative yield advantage, and general risk trends are very tied up into this particular piece of event risk. All right? A lot is riding on what happens next week. In the meantime, we do have some pretty exceptional volatility. We have to see whether the volatility we had this past session continues, and if it does, we have a very different picture than if it just simply settles, because we're going to be looking forward to a much more active week of scheduled event risk. Keep all this in mind. I'll update you for next week tomorrow.